Warren Buffett has invested billions of dollars into Paramount, or at least one of his lieutenants, if not him, has done the investing. But the question is, what exactly is the opportunity here? And does it make sense for us to invest in this opportunity as well? And that's what I'm going to dive into in this video. So guys, smash that like button, subscribe if you're new, and of course, drop a meow in that chat. You're watching More Money. Let's get it. What's up, guys? And you guys already know that I don't invest in everything that Berkshire Hathaway invests into. If that was the case, I would just own Berkshire Hathaway. But what I do like to do is I like to look at super investors, see what they're investing in, and then deep dive into those potential opportunities for myself and see if it makes sense. And so what I end up doing is I end up creating this portfolio where I've sort of picked out certain alpha type opportunities from all sorts of super investors, in addition to opportunities that I myself found, like the Vista Outdoor spinoff, which I talked about a couple of videos ago. And so let's dive into this opportunity. So you can see here's an article from May where it said that Warren Buffett invested $2.6 billion in Paramount. And you can see in Q2 of 2022, Warren Buffett continued to invest into this Paramount position. But I do have to say, and I have to make this warning for you guys, that do not take portfolio inclusion and exclusion cues from Warren Buffett. He is very, very active. But by all means, look at what he's buying as a cue for your own research. So the question is, what exactly does Paramount do? You guys already know that they create content, but exactly what content? So you can see that they have three divisions. They have the TV media division, they have their direct-to-consumer division, and they have their filmed entertainment division. So the TV media is exactly what they say. They have broadcast networks like CBS, BET, Nickelodeon, MTV, etc. Their direct-to-consumer is their Paramount Plus subscription service and Pluto TV free-to-view service. And then, of course, they have their filmed entertainment space. So that's where their Paramount Pictures lives. Of course, you guys may have seen Top Gun recently. That was done by this company. But the point I want to make here is that no matter what medium wins in the future, Paramount is leveraged in that space. So let me give you an example. So if TV continues to do well, they have TV broadcast networks. If streaming does well, they have Paramount Plus. If free TV does well, they have Pluto. And of course, if there's a resurgence of people going to the movies, they got their filmed entertainment division as well. And so they've covered all areas in which we consume media. Now, the CEO of Paramount actually dives deeper into this with his strategy, and I absolutely believe that this guy is a genius. And so this is an opportunity that I personally am going to be investing into, and I'm going to explain to you in this video why. Now, the first thing that I want to show you about this company is that it's very similar to Alibaba, and here's why. One segment of the overall business is cash flow positive. That's their TV media business. Everything else is developing. So you can see that their TV media business over the last 6 months generated approximately $3 billion of essentially free cash flow. Their direct-to-consumer business is still losing money, and their filmed entertainment business is profitable, albeit it's choppy. Now, the one thing that I really appreciate these guys for doing, notice how they took stock-based compensation out of their free cash flow calculation. I really appreciate management for doing this, because you guys know on this video, especially in that valuation for Alibaba that I made, a lot of companies like to report free cash flow or adjusted EBITDA, which is essentially free cash flow without taking out stock-based compensation. And so the only reason why management would do this is because they really are owner focused. And so this is a company where there's no huge upside for them doing this, but they do it despite that. And what it tells me is that I'm willing to own this business because they essentially fess up what their stock-based compensation is and how much they're taking away from shareholders from the perspective of diluting the shares. And so I really love that they put this in their adjusted EBITDA calculation. They call it something else. They call it like adjusted OJIBA or whatever, but I really love this, and it shows that these guys are ownership focused, and effectively I can't say enough good things. So let's move on. Now, this is their direct-to-consumer segment, and I wanted to show this because this segment is losing money right now, but notice that both Paramount Plus and Pluto TV are growing very fast. So over the last year, from 2020 to the end of 2021, the number of subscribers for Paramount Plus tripled, and then obviously, they've gone up by another, 33% in the 6 months ended in fiscal year Q2 of 2022. And then notice that the monthly active users for Pluto TV have also skyrocketed from 43 million monthly active users to close to 70 million monthly active users just a year and a half later. So overall, these segments are growing. However, competition is getting very fierce in this space. So we'll see how this plays out for their direct-to-consumer business. One, I like that they're segmenting this out this way. And two, I like that they're continuing to invest in this space. And so I do believe that both Paramount Plus and Pluto will become cash flow generators in the future. And so I do agree with them of continuing to invest in this space. And what I want to show you guys here is that even if direct-to-consumer and filmed entertainment effectively make zero profit, notice that I believe that in the future, owning broadcasting networks is incredibly important, and it allows for them to have content that's very important in the streaming world. Notice that they have the Showtime brand, they have the CBS Sports Network, in addition to all those stations. So I do believe that this is a sustainable competitive advantage for them to own all of those cable networks, especially in an environment where streamers are very hungry for content. And so these guys have content that they can either sell to other streamers or put it on Paramount Plus or offer it for free on Pluto and use the ad-supported model. So there's a lot of options for them here to complement the profitability for broadcasted content. Now, there is an article that speculates as to why Warren Buffett may have bought Paramount stock. And I think the two important points here are that one, it looks like Warren Buffett is seeing the TV broadcasting cash cow business the same way that we are on this channel. And two is a warning for you. I do believe that things can turn around quickly in this space, especially as ad revenues dry up or TV ratings drag. So the one thing that I do want to point out to you guys is that this is not a slam dunk opportunity. And you'll notice that on this channel, I always try to spit out the good and the bad. And so this is a huge risk for this business. In the past, Paramount has had viewership issues, and in the future, they could have the same issues as well as declining ad revenue. So be careful, and if you're going to invest in this space, diversify accordingly. Now, here in this article is where I think you can get into the crux of the opportunity. Note that Paramount's free cash flow is right now generating a free cash flow yield of approximately 3.4%, but analysts do believe that the free cash flow could reach as much as $2 billion by 2026. And so what you have here is a combination of traditional assets and streaming assets, which becomes a real advantage for the company. And here's what their CEO said. He gave two examples of how old-fashioned distribution can lower the risk of creating streaming content. And so the first example is Paramount introduced a cowboy show called 1883 on cable to its fans of its hit Yellowstone before moving 1883 exclusively to Paramount Plus. And the company has used a 45-day theater window to help make back the costs of movies that they ended up streaming with as well. So that, I believe, is a super smart move. I do believe that they're integrating these outlets in a way to increase the profitability overall for the company in a way that gives them a competitive advantage that places like Netflix don't necessarily have at the moment. Now, guys, remember when I said that advertising rates could dry up? That could potentially be a risk for this business. Well, that's exactly what we've been seeing in 2022. A lot of companies have been talking about it, and I want to show you how you're seeing it in Paramount's financials. So you can see here that in June of 2022, their operating expenses as a percentage of revenues is now 66%, up from 59% in 2021. And for the 6 months ended, it's the same. And so what's really happening here is that advertising rates have come down, which means, of course, that the company is less profitable in 2022. So what I would reiterate here is that be careful. Advertising rates look to be declining in this environment, pushing down profitability, which you can see now with the cost as a percentage of revenues declining. So once again, guys, you guys are aware of the risk in this security. Now, note here, this is what they said in their Q2 results, and they actually dispute what I'm saying, and so I might actually be wrong, but they're saying that for the 3 months ended June 30th, advertising revenues did decline 2%, but the reason why those advertising revenues declined is because they've lower impressions on their broadcast and cable networks, which were partially offset by higher pricing. And so I might actually be wrong right now on my analysis when I say that advertising rates are the reason why operating expenses as a percentage of revenues is higher. It might just be that operating expenses are just creeping up right now, but I just find it very hard to believe that advertising rates for this one company are going up while rates across the industry are going down. And so I don't know what to think, but I do believe that we're heading into a weaker environment right now. And so you could see advertising rates being called out as a driver for lower revenues going forward. So we'll see how this all plays out, but I just sort of wanted to explain what I initially saw relative to what the company is saying right now. And from here, you can see that they don't have a ton of debt relative to the assets that they have on the balance sheet, but they have been paying it down quickly nonetheless. Debt is down 20% from fiscal year 2020. And so what that really means is that when you look at Paramount and you compare it to Warner Brothers Discovery, Paramount has much less debt on their balance sheet, which makes it a safer play overall in a rising interest rate environment. Now, here's my model on Paramount. You can see that on the top left, for every model that the Patreons get access to, you have this click button at the top left where you can go back to the tracker, and the tracker is what tracks every stock that we cover. But notice that in beginning of 2022, they will report results based on the following segments: TV media, direct-to-consumer, and film entertainment. So I'm going to revamp this model once they provide that look-back disclosure. But for now, I'm using their old segmentation. You can see it here. But note that revenue has not been growing in a linear fashion. So in 2023, it grew 9%. In 2024, it declined 10%. In 2017, it looked like it grew 100%. And then in 2018, it declined. So the point I'm trying to make is that revenue hasn't been a linear increase overall for this company. And so when you value them, you really should be taking a huge margin of safety and expect choppy results into the future. Now, here's my look forward for this company for the next 10 years. Of course, I'm not going to predict choppy results, but what I will predict is a very low growth rate. So in 2021, they grew revenues by 13%. I just don't think that that's going to happen over the long term. And so I'm just growing revenues at 5% over the next 10 years. And so, like I said before, once they provide the comparable for the new segments on an annual basis, I'll forecast those segments out using their new groupings. But overall, I do believe that those segments themselves, I will grow it at 5%. And I do believe that that could be a bit high in this environment. And so I might even bring down the near-term years, but I do think that they probably can get it. You can always reduce costs. And so what ends up happening is you take it on the revenue, but then those lower costs allow you to continue a strong EPS number. And so they can pull a lot of levers. And so I'm just comfortable with forecasting 5% revenue growth out into the future. But here's an example of the part of the valuation that's very subjective. So you guys let me know what you think. Is the 5% aggressive or is it too pessimistic? I'm really not sure, and I'm very excited to know what you guys think in the comments below. Now, before I go into my valuation, I do want to note that 80% of the watch time is coming from people who aren't subscribed to the channel. So guys, please, if you have the opportunity, please consider subscribing to the channel. And now here's my valuation. So you can see that using a terminal multiple of 12.5 times earnings, I'm valuing the company at approximately $57 per share. But notice that I'm penalizing them $18 per share for the debt that they have on the balance sheet. So if you don't want to penalize them for that whole debt amount on their balance sheet, there's some upside for you here. But based on the current share price of $26 per share, the company's trading at under 50% of its intrinsic value. So it's very opportunistic to enter into this opportunity right now. Now, once again, that's not investment advice. It never is. Always speak to your investment advisor. But from the valuation that I'm seeing a really attractive opportunity right now. Now, in order for you to get access to that model and all the other models and the trackers that the Patreons get access to, you can get access to all of that at the lower tier of the Patreon. And like I always say, if you're not satisfied, I don't want to take any of your money. So if you aren't satisfied within the first 30 days, let me know and I'll completely refund your first 30-day subscription. Now, I did make a video on one of their competitors, Warner Brothers Discovery, and you can actually get to that video right here.